Hey everybody, welcome back. Today we're going to talk about debits and credits. We're in chapter 2. Let me give you the big picture and then we'll get into the details. In chapter 2, at the end of chapter 2, we're going to prepare financial statements that look exactly like what we did in chapter 1. In chapter 1, we recorded pluses and minuses to items in the accounting equation. We're going to do that again in chapter 2, but in chapter 2 we're going to organize the pluses and minuses with what's called debits and credits. It's just a way to be more efficient, and also it's kind of a self-checking mechanism. But at the end of chapter 2 we're going to prepare the same financial statements that we did in chapter 1. So the only thing really different in chapter 2 is how we organize these pluses and minuses. Let me kind of give you the kind of the framework we're going to be fitting things into. Well, let's talk about. Let me get my picture out of the way first. Okay. To introduce this, I'm using the transactions from problem 2.1a in the back of chapter 2. So let's look at the first 3 transactions the way we would in chapter 1. First of all, we collected $10,000 as investments from stockholders. So we added $10,000 to cash and we added $10,000 to common stock. Again, everything is within the context of the accounting equation: assets equal liabilities plus owner's equity. In the second transaction, we paid $4,800 of rent in advance. So we subtracted $4,800 from cash and we added to this other asset prepaid rent. In the third transaction, we provided $62,000 of services to clients. Anytime we provide services, we add revenue under retained earnings. So we added $62,000 of revenue. And we added $48,000 for the amount that we collected in cash. The other $14,000 we added to accounts receivable because that's what customers still owe us. Now you can imagine that this chart, where we are recording these pluses and minuses, can get extremely large very quickly in a real life situation. So to make it more efficient to record the pluses and minuses, what we're going to do is we're going to take every column and divide it in half. The left side of every column we're going to call an account. The left side of every account is going to be the debit side, and the right is the credit side. So let me look at this in general first. So again, we're going to take every asset column, and the debit side goes on the left, the credit is on the right. Same thing with your liabilities and equity. The debit's go on the left and the credit's on the right. What's different is, where do you record the pluses and minuses? When you're on the left side of the equation, left side of the equal sign, we're going to put the pluses on the left, which is the debit side. Therefore, the minuses will be credits. When you're on the right side of the equal sign, liabilities and owner's equity, we're going to record the pluses on the right, which would be credits. And therefore, the minuses will be debits. So again, if you're thinking about the equal sign here, the pluses are the side that's away from the equal sign. So assets, the pluses are debits, and liabilities and equity, the pluses are credits. We can expand this out to have the whole equation. So again, here's the equal sign. Assets, the pluses are on the left. Remember, assets are on the left of the equal sign, so the pluses are on the left. Liabilities and owner's equity, all of that is to the right of the equal sign. The pluses go on the right. So every account is like a set of scales. And so, if like on the assets, if you're adding to the debits, the scale tilts over toward the debit side, and then as you subtract, you'll remove items with a credit, but it'll be leaning over towards the plus side. That's why we have the check mark. The check mark is where does the balance tend to be? And the balance tends to be on the plus side. So assets tend to have a debit balance. Liabilities and owner's equity tend to have a credit balance. So let's go back and apply that to these transactions that we've been talking about. In the first one, when we collected, let me move this. So here's our accounts. So in the first one, we added $10,000 to cash. Cash is an asset, and so therefore we add on the left. So we're going to add $10,000 with a debit to cash. That's transaction A. And the other part of that transaction was to add to common stock. Well, when we add to owner's equity is to the right of the equal sign, so we're going to add that on the right, which is the credit side. So we're going to add $10,000 to common stock with a credit, and again, that's transaction A. You might notice that the credits are abbreviated CR, which makes sense. The debit is abbreviated DR, which doesn't make sense. That's the word debit comes from some Latin term debire, D-E-B-I-R-E, and for some reason the D and the R stuck around, so the abbreviation for debit is DR. Transaction B, we paid for rent in advance, $4,800. So we are subtracting from cash. Cash is an asset. When you subtract from cash, you're going to credit cash. Again, think about how it's treated in the equation. Cash is an asset. Assets increase with debits, and the minuses go on the right, which is a credit. So in this problem, we're going to credit cash for $4,800. That's transaction B. And we're going to add to prepaid rent $4,800. And again, that's transaction B. Now, a couple things I want you to notice here is, first of all, I did not have to put the brackets around the $4,800 because the credit indicates it's a minus. So anything, when we're talking about an asset, anything in the debit side is a plus. Anything on the credit side is a minus. Also, we're going to be saving space because we don't have to keep skipping down as we go. We're able to organize things more efficiently within these accounts. And each of these accounts, we talk about it as a T account because they all look like a T. Okay, now let's look at transaction C. Transaction C, we added $48,000 to cash. Anytime you add to an asset, that's a debit, so $48,000 is added to cash. We're also adding to accounts receivable, so that's $14,000, transaction C, adding to accounts receivable. And we are adding over here to retained earnings. Anytime you add to retained earnings, that would be a credit, $62,000. And again, that's for revenue. Now, let me talk about a couple of issues that are going on here. First of all, under retained earnings. If we put all of the pluses and minuses to retained earnings all right here together, we're going to get all that information kind of jumbled up together, and it's going to make it difficult to make the income statement when it comes time to do that. So we're going to take all the pluses and minuses to retained earnings. We're going to group together underneath retained earnings. So this credit of $62,000, instead of putting that in the retained earnings account, I'm going to come down here, and I'm going to put all the revenues together so that when we're through, all we got to do is add up this revenue account, and we'll have the total revenues all grouped together already. So it saves us some time when we make our income statement. Revenues, of course, are credits because they are pluses to retained earnings. Now, when we're recording expenses and dividends, those would be debits because they are minuses to retained earnings. So let me go over here to this kind of general structure again. Remember, as you think about where to put the pluses and minuses, everything to the left of the equal sign, assets, the pluses go on the left, which are debits. So the minuses are credits. Everything to the right of the equal sign, the pluses go on the right, which are credits. When we're under retained earnings here, all the pluses are revenues, and we're going to group all those together as credits to the revenue account. When we start recording minuses to retained earnings for either expenses or dividends, we're going to group those together in separate expense accounts or the dividend account, and those are all debits because those are actually minuses to retained earnings. And all of these things under retained earnings, I am drawing with a dotted line account. That's because we're not talking about a brand new column. We're still under the retained earnings, but we're just these are like sub-classifications under retained earnings. So all of the revenues we will combine together as credits here in the revenue account. And when we're through, we'll just add up all of those revenues, and that'll give us the total that we'll take to the income statement. So you'll see this kind of play out as we go. So let's go back over here to the sample problem and see how this fits in. So we have $62,000 credit to the revenue account, and we had a debit to the cash and accounts receivable for transaction C. Now all of these accounts together, this is called the ledger. And here we have a simple homework problem, and we have all of these accounts represented right here on the single screen. In reality, every account, well, to think about the accounting system, it's easier to think about the old pencil and paper system. Think about your checkbook. In a checkbook, you have a column for pluses, a column for minuses, and then a running balance column. Well, in a typical accounting system, every one of these T accounts would look like your checkbook. So you would have, again, a column for pluses, a column for minuses, and then a running balance column. So like your cash account might actually, if you think about a checkbook, it can take up pages and pages. So every account would actually have multiple pages to it. So it would be hard to represent all of the accounts right here together on one screen. So in reality, this ledger might actually be a big book. And so the first few pages are taken up with the cash account, and then you've got the accounts receivable account, and so on. So when you have everything in a big book like that, it would be easy to get it mixed up as to what debit goes with what credit. So because of that, before we record items in the ledger like we're doing here, we put them first into the journal. And I just happen to have a journal right over here. So let me show you how that works. So I've got the first, let me just kind of uncover some transactions here. So in a journal, we're going to have the accounts, we're going to list out the accounts that we're going to be affecting, and then we will indicate whether or not we're going to record a debit or a credit. So here's the way it happens. A transaction happens, like transaction A, where we collected $10,000 from stockholders. We're going to first record that transaction in the journal, where we indicate what accounts are going to be affected and whether or not they get a debit or a credit. Then we're going to take the debits, the numbers from the journal to the ledger. That's called posting. So this $10,000 debit to cash, we would post to the cash account. The $10,000 credit to common stock, we would post over here to the common stock account in the ledger. So again, this is the journal, and the journal looks kind of like a sheet of notebook paper, just with lines on it, except for the two columns out there for debits and credits. And then we post from the journal to the ledger. So like the second transaction, transaction B, is we recorded a debit to prepaid rent and then a credit to cash. And then we would post the debit to prepaid rent and post the credit to cash. So we record the journal entry first and then we post to the ledger. Let's look at transaction C. Oops. Transaction C, we have a debit to cash, $48,000, and here we posted that to the ledger. We had a debit to accounts receivable of $14,000, and here it is in the ledger. And then we had a credit to the revenue account, which we know is under retained earnings, and so there that is. So again, we record things first in the journal, and then we post to the ledger. So another benefit of the journal is we can always see, it's always going to be true that your debits will equal your credits. So there's always at least one debit and one credit, but like in transaction C, you can see that we had two debits, but those total debits will always equal the total credits. So it's another way to kind of check to see that you're doing right. Okay, so let's continue on and kind of see how this process works. In transaction D, we pay $21,000 wages to employees. So first of all, we paid cash. So we're going to subtract from cash. Now, if you think about the cash account, cash is an asset, so when we subtract from cash, that's going to be a credit. So in the ledger or the journal here, I'm going to credit the cash account for $21,000. The debit goes to wages expense. Now why is that a debit? Because all expenses are debits because they are really minuses to retained earnings. Remember, everything under here, all of these dotted line accounts. We call these temporary accounts because we're just using them temporarily to group the pluses and minuses to retained earnings together. So expenses are debits because they are minuses to retained earnings. So here's the journal entry, and we're going to post this. The debit to wages expense will be recorded here, 21,000. That's item D, transaction D. And the credit to cash would be recorded here, 21,000. Credit to cash. Okay, the next item, transaction E. We collected $8,000 in advance from clients. Okay, so you want to ask yourself, first of all, what was affected? Well, we collected $8,000 in cash, so we're going to add to cash. And we got this in advance from our clients, which means that we still owe them something, so we're going to increase unearned revenue. So ask yourself, what was affected? Did it go up or down? And is that a debit or a credit? So cash was affected. It went up. Anytime you add to an asset, that would be a debit. So we're going to debit cash for that $8,000. The other thing that was affected was unearned rent. Unearned rent is a liability, and it went up. Anytime you add to a liability, that would be a credit. Again, you can always refer to the chart here, but anytime you add to a liability, that would be a credit. So we're going to add to unearned revenue with that $8,000 credit. So I'll post that to the ledger. The $8,000 debit for cash goes here, it's transaction E, and the credit to unearned revenue goes over here. That's item E. And you may be thinking, why are we complicating this so much? Because, it's like all these debits and credits get all, you got to think about, okay, where does it go? Well, after you get used to thinking about it, and again, it's pretty straightforward. You just have to remember how the pluses and minuses are organized. As you think about the equal sign, anytime you add to something on the left, an asset, you're going to record a debit. All assets, the pluses are debits. If you subtract from an asset, that would be a credit. Anytime you're on the right-hand side of the equal sign, the pluses go on the right. So if you add to a liability like unearned revenue, did it go up? That would be a credit. If it comes down, that would be a debit for those minuses. Same thing with paid-in capital, or anytime you're under retained earnings. Anytime you add to retained earnings, which would be revenues, those would be credits. Anytime you reduce retained earnings with either an expense or a dividend, those would be a debit because you're reducing retained earnings. So let's continue on with the transactions in the problem here. Item F, we collected $9,000 on account from clients. So our clients are paying us on what they owe us. So we would add to cash because we are collecting cash. Cash is an asset. Anytime you add to an asset, that's a debit. We're also going to subtract from accounts receivable because they are paying off their balance, and so they're reducing what they owe us. Anytime you subtract from an asset, that's a credit. So we'll then post to the ledger that $9,000 debit goes here, item F, and the credit to accounts receivable goes here. It's item F. Again, if you think about accounts receivable, if we had to stop right now, accounts receivable has a $5,000 debit balance because we had a $14,000 debit offset by a $9,000 credit. So in a minute, when we're through, we're going to get a balance for every account, and those account balances are the numbers that we'll be preparing the financial statements with. So let's go ahead and finish up. Item G, we paid a dividend to stockholders. So here is the journal entry. A dividend, we are subtracting from retained earnings. Anytime you reduce retained earnings, that's a debit. So we're going to debit the dividend account, and we are subtracting from cash, so that'll be a credit. And then we will post to the ledger the debit of $3,000 would be debited to the dividend account. That's item G. And the credit of $3,000 would go up here to the cash account, item G. Item H, we provided $5,500 of services to clients who had paid in advance in E. So up in E, we added $8,000 to the unearned revenue because the customers paid us in advance, and now we have provided those services, so we're going to reduce that unearned revenue. So we will record a debit to unearned revenue to reduce that liability, and of course anytime we provide services, we're going to credit the revenue account for $5,500 in this case. So then I'll post that. The debit of $5,500 goes here. Debit unearned revenue, item H. And the credit to revenue would go over here, $5,500, item H. Okay, then one more item. We're going to record the expired portion of rent, 8 months worth. So if you remember, we had prepaid our rent for 2 years. That was $2,400 or $200 a month. And now 8 months has expired, so that would be $1,600. So in the journal, we would record a credit to prepaid rent, reducing that asset, and a debit to rent expense for those 8 months that have expired. And so when I post that entry, prepaid rent gets a credit of $1,600, and the rent expense gets a debit of $1,600. Transaction I. Okay, so that is all the transactions, and if you wanted to, you could add up everything in the journal just to make sure your debits equal your credits and you haven't made a mistake in there someplace. But once everything is posted to the ledger, and again, let's just kind of remember the process. A transaction happened. We recorded that transaction in the journal first. That's where you kind of get it straight as to what needs to be debited, what needs to be credited. You can see the whole transaction together. And then we post from the journal to the ledger. And so now when we're through, when we get to the end of the period, we're going to balance up every account. So first of all, the cash account is going to have a debit balance. So the balance is going to be all of these debits added together minus all of these credits. So the balance in the cash account is $46,200. We can do the same thing for accounts receivable. The balance in accounts receivable is equal to that $14,000 debit minus that $9,000 credit. So a balance of $5,000. Let's go to the other side. The unearned revenue. Unearned revenue is a liability. And liabilities, if you think about the general structure, with liabilities, the check mark is on the credit side, meaning the balance tends to be on the credit side. That's where the pluses are. So, and we can easily see that, there's more credits than debits. So the balance in that unearned revenue is going to be equal to that $8,000 credit minus the $5,500 debit, or a credit balance of $2,500. So we're going to do that for every account. Determine the balance for every account. And when we're over here in these temporary accounts, like the revenue, the only thing in the revenue account are credits. And so it's real easy to simply add up those credits, and that gives us the total revenue, which will go straight to the income statement. So if I go to the next page here, so I went to the other page, and I have all of the accounts already balanced up, and then those account balances go to the financial statements. And here in the middle of the page, I've created the financial statements. So first of all, if you look here at the income statement, and the income statement, remember, is revenue minus expenses, and all of the information that goes on the income statement comes from these revenue and expense accounts over here. So there's the revenue of $67,500, and then we would subtract our total expenses. That total consists of the wages and rent expense that comes from the ledger, and the revenue minus the total expenses, that's our net income of $44,900. That $44,900 net income goes to the statement of retained earnings. Here it is over here, added to the beginning balance of retained earnings, which is 0. This is our first year of operation. So here's our retained earnings. I'll put that in blue. And so I'm just going to kind of blue out everything from start to finish. All of this information here is included in retained earnings. So we started with a 0 balance, and then we add the net income that came over from the income statement, and then we're going to subtract the dividends. Tell you what, just to be able to see this a little bit better, I'll make that blue, and then down here this is blue as well. And I don't want to change the color of the revenues and expenses because that goes to the income statement first. But then that information is included on the statement of retained earnings, and we come up with an ending balance for retained earnings of $41,900. And that's what appears on the balance sheet down here. So the retained earnings of $41,900, that's on the balance sheet. And also on the balance sheet are these all these different account balances for assets. liabilities, and the owner's equity in total. So I'll tell you what I'll do. I will kind of make all of those just so we can see the connection. All those will be purple. And that's the color I've got for my balance sheet. And so all of this information the total retained earnings, of course, is also on the balance sheet. So, see, I didn't get that one. So, the balance sheet, again, is all of these assets, adding up to $54,400, and that equals the sum of the liabilities and the owner's equity, consisting of the paid-in capital common stock and that ending balance of retained earnings. So, again, these are the same financial statements that we would prepare at the end of Chapter 1, where we just simply recorded pluses and minuses. We just did it with debits and credits. And again, as you're learning the debits and credits, you kind of wonder, why are we making this so complicated? Well, when you have a lot of information, the debits and credits ends up being much more efficient. So it's like we're learning a new language, debits and credits, to organize the pluses and minuses. So work with that, practice that, do a lot of homework, and the more you do, the debits and credits becomes a more automatic way to think about it. For example, if you were learning a new language, like Spanish, when you're first learning a language, you have to think in English, and then in your head you would translate it to Spanish. But if you're fluent in Spanish, then you would think in Spanish. Well, the more you practice with this, the less you have to think about pluses and minuses and where do they go, and you just start automatically thinking about debits and credits. So in the back of Chapter 2, there is a chart that looks like this, and as you're doing the homework in Chapter 2, I would constantly refer to this chart to remember where do the debits and where do you record things. And again, here's the equal sign. Anytime you're to the left of the equal sign with an asset account, the pluses are debits and the minuses are credits. But anytime you're to the right of the equal sign, then the pluses go on the right with credits, and that's also where you would tend to find the balance in those accounts. So good luck with that, and I hope you have fun.